Hi, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for November 19th, 2012. This week's topic, when strength does not mean optimism. For those who are not subscribers to this YouTube channel, I encourage you to do so to get automatic updates when new videos are uploaded. As well, if you want to receive my free weekly newsletter, go to the address that you see on screen. All right, let's get into the topic for the week, when strength does not mean optimism. One of the things that I like to do as a trader is follow abnormal buying activity because it's often caused by a significant change in fundamentals. In that case, it is a sign of investor optimism about the company's future. However, there are times when strong buying is simply a matter of the short sellers covering their positions, or situations where the buyers just believe prices are too low. These are not situations where the buyers are optimistic about the future. They're just not as pessimistic as they were in the past. Now, when buyers act on optimism, trends often develop. But in other cases where the buying is coming in as a end of pessimism or just simply to cover short positions, that's not a situation where we want to follow the buyers thinking that they are buying for good reasons. If you look at the chart of the S&P 500 going back the last month, you can see that today we had a pretty good rally in the market. And many will say that that is a sign that the buyers are optimistic. But in the context of the downward sloping channel, you can see that really this was just a bounce back from oversold conditions. And the strength is likely to end at the upper boundary of that downward sloping channel at the red line. Now, it doesn't mean it has to end there. It certainly could be the start of a trend reversal. But the kind of strength that we saw today is typically what we call a bull trap, where the buyers are suckered into chasing the market higher only to find that ultimately the pessimism is still the case for the market. All right, let's get into the analysis of the overall market then, starting off with the chart of the S&P 500. And as I said, we had a pretty good bounce back today, but it did not break the pessimism. And therefore, we should remain on the pessimistic side of neutral right now. It is a good sign that the market was able to bounce like it did, but really it's just bouncing back from oversold conditions. And until we break that down red line on the chart that you see there, I wouldn't get too excited. Here's the chart of the TSX, and it too was very oversold, bounced off of support at the green line, made a little rally today, but still has lots of work to do before it can break out through resistance at the red line. So today's a good step in the right direction, but it is by no means an endorsement that the buyers are back in control. Here's a chart of the the Russell 2000, which is the smaller cap stocks that trade in the United States. This is the ETF symbol IWM, and it too had a bounce back today, although with not as much vigor as the bigger market. And that's largely because the big market was guided higher by big names like Apple today, and the smaller names really didn't participate in the rally as much. And so again, another sign that the buyers aren't really optimistic about the future. They're just not as pessimistic as they were last week. Here's more proof of that. This is a chart of the 20-year bond ETF, TLT. This is a chart that tends to go up when the market goes down, and we saw money coming back into treasuries as it looked to hide from the riskiness of stocks over the last couple of weeks. Well, today, on a day when the market was pretty strong, the TLT wasn't really all that weak. And that tells me that money is still looking for safety and is not running back for stocks, as it would seem by the rally in the market today. US dollar tends to be reversely correlated to the overall market. It was down today, but again, not so much relative to the gains in the stock market. I think the rally today was relatively narrow in focus. The broader market didn't really do great, and the US dollar hasn't yet broken that upward trend line. Now, it is flirting with it, although I'm still feeling like the US dollar is the go-to currency right now. Gold had a breakout from a pennant pattern. That's a good sign if you're a gold bug. Looks to me more likely to go higher than lower in the near term, and that will help the commodity-based sectors in the mining area. But still not a great chart, not a lot of upside potential until we get to resistance at about 173, 174 on the ETF. Oil made a break of its downward trend line, pretty oversold on oil, probably rallies back here on some short covering, of course motivated by tensions in the Middle East. those events tend to always work themselves out, and any strength tends to be short-lived. So I wouldn't be a long-term optimist on oil just yet, but it's quite possible that we will see it continue to bounce higher, particularly if the tensions between Israel and its neighbors continue to increase. So my outlook then is neutral in everything. I would say I'm on the pessimistic side of neutral for stocks, but we'll call it neutral. Gold, I'm probably on the optimistic side of neutral, but not tremendous upside. Oil, yeah, looks like it could bounce back for a few days, but pretty unpredictable. It's going to move on headlines coming out of the Middle East. The markets have bounced back from oversold conditions today, but have not yet broken the pessimism. The bounce is a good first step, but I would continue to trade with caution as the market remains concerned about U.S. tax increases and spending cuts, those things otherwise known as the fiscal cliff. Well, that has been the Stockscores Market Minutes for November 19th, 2012. Have a great week in the market and trade well.